Hi, I'm Jamie Flunchball again. We're here to talk about strategic thinking and have a good friend, a longtime friend, Steve Cook, Executive Managing Director of LFM Capital with us. So, Steve, why don't you tell us more about yourself?
Sure. Well, first of all, Jamie and I have known each other since, I guess, 1996, so it is definitely a long time now.
Long time.
We ended up going to graduate school together. Yeah, briefly on my background, I've got a bachelor's electrical engineering from the Naval Academy. I spent 7 years flying off aircraft carriers, the last 2 years in a test squadron, and then went to this program that Jamie and I went to together called Leaders for Manufacturing. So that's actually where the name the LFM Capital came from. I spent 11 years with Dell after graduating from the program. Um, really nice cross-functional opportunities in manufacturing, supply chain, engineering, and sales. Led a 2,400 person manufacturing plant for Dell. Led about an 800 person sales organization for Dell. And then did 1 year as COO of a venture capital funded company of about 300 people. And then moved into private equity about a decade ago. I spent 4 years at a similar firm in Nashville, and then started up LFM Capital in 2014. We're about just a 12-person organization. We've raised two funds. We only invest in U.S. and Canadian manufacturing companies. We've got 9 companies in our portfolio so far. And 3 of the 4 partners all attended that same graduate program. So we're definitely pretty, I would say, kind of manufacturing geeks, and pretty data driven and pretty operationally involved, trying to partner with the leadership teams for the companies that we invest in.
Yeah, and I think that's, we've had a range of different folks on these interviews, but, you get to sort of practice strategy every time you make an investment in a new firm, as well as working with your portfolio companies. So it's a great practice ground for that. But actually, I want to start with a question that hadn't occurred to me before. But a lot of strategy has its roots in military, and today, perhaps the most dynamic decision-making place is aviation from a military standpoint. So just kind of curious, being a naval aviator, was there, a lot of strategic lessons that you've extracted from that experience that, whether deliberately or accidentally, influences you today?
And I would say aviation is a good training ground in that it forces you to be incredibly process oriented, and you have to make decisions quickly, and you stay very mission oriented. And so, I've told investors in the past that obviously there's not a lot of overlap between private equity and naval aviation, other than the fact that in both cases you are weighing risks and rewards.
Right.
In naval aviation, the risks are a lot higher. There's nothing I'm doing in my current role that might cost me my life. When I was in the Navy, just looking statistically at it, the people that were flying my plane, I had about a 1 in 100 chance of dying every year. So definitely take those risks very seriously. There's a lot of preparation before you go out and fly a mission. You do a pretty thorough debrief when you're done. A lot of those, I would say, are in some ways similar to how you think about lean and that kind of continuous improvement mentality, and learning what you can from every experience. The time in the cockpit is quite precious. I think it was like $10,000 an hour to get us up in the air, and so you want to take max advantage of that when you're on a training mission.
Yeah, absolutely. And then, it's not a bad definition of strategy, right? Dynamic, rapid decision making, measuring risk and reward. It's not a half bad definition in its own right. So getting into strategy more in your current role, you have opportunities to craft strategy yourself, to encourage your portfolio companies to own their strategies. Obviously, you can have very few or many people involved in that. How do you think about how many people need to be involved in the process of crafting strategy? And maybe just building on that, how do you practice that as a portfolio manager?
Sure. I would say, like most things, that it needs to be a team that has high trust and is not too large that it just can't function effectively. So I would say when we have strategy sessions with our portfolio companies, it's typically 5 or 6 people from the company, and trying to represent all of the different functional areas, and just one or maybe 2, 3 from LFM. So if you think about like 8 is probably a good like kind of max. When you start getting above 8 people, it's hard to all sit around a table together, and it's just hard to move quickly. I think every person you add to a team can add a diverse way of thinking about it, and can definitely add to the process. But I would also say every person you add to a team kind of slows that down. And so it's finding that right balance between having enough diverse views and different stakeholders, and being able to move quickly and come to an alignment and move forward.
Yeah, I think, two key pieces there, right? It's really easy to get agreement with yourself if you have a team of one, right? But you get diversity of thought by adding people, but you also have to go execute that. And so you want that alignment that you talk about coming out of the session, so that you can actually deliver on the strategy. And so that needs certain amount of inclusion to make sure you're aligned going forward.
Yeah, and I would definitely say, just to follow up a little bit, the inclusion you mentioned is really important. If you don't have the right people involved from the company, they're not going to own it. You can't kind of cram a strategy down a leadership team's throat, and if they don't own it, it's not going to happen. 90% of strategy, in my opinion, is execution. You can have the best plan in the world, and if you don't execute it, it doesn't amount to anything. You might not have the perfect plan, but if you execute it really well, you're probably going to be pretty successful.
Yeah. Yeah, absolutely. It's strategy doesn't live on paper.
Right.
It's got to ultimately result in action. So curious, who leads that? So when you do these joint sessions between LFM Capital and a portfolio management team, how do you structure that? Who actually leads the process for that?
The way we've typically structured it is that the ultimate leader is the CEO of the company, but the facilitator is typically one of my partners, whose name is Chris Lynn. He did attend the same program as you and I, Jamie, but also was a Bain consultant both before and after the LFM program, and so he's particularly well suited to lead a session like that. You can imagine he was charging a lot more when he was at Bain, and so he's typically facilitating it. I would say there's typically going to be 1 or 2 other people from LFM involved, and then the CEO and most of the CEO's direct reports, or all of them, depending on what the structure looks like. But at the end of the day, again, it can't be an LFM led exercise, because we're not going to ever be there to execute it. It's got to be owned by the CEO and his and her or her leadership team when we walk away from a strategy session.
Yeah, I think I think that's pretty vital. As one of the interviewees talked about, it's not just what the actions are going to be; it's also the energy and commitment you put into those actions. And boy, if you have a CEO that's not committed to the strategy, your
You've already
vector,
failed.
you might have the right direction, but your vector is going to be really short. So.
Yeah, you've already failed. The company leadership team needs to leave a strategy session really passionate about the strategy that you've landed on, because like you said, it's all about selling that to the rest of the company when they get back, to wherever the company, and then executing on it. And at the end of the day, a good strategy is simple enough that you can, filter it down to the entire organization, and it just helps drive every tactical decision. And even at the frontline supervisor level, if they really understand that strategy, then when they're deciding, do I work overtime or not, it plays into that decision. And that's really the ultimate test, in my opinion, of a successful execution of a strategy. Is does if I walk the floor, could just about everybody I ask, would they be able to kind of articulate in their own words what the strategy is and how they play into it?
Mm-hmm. That's a pretty good test. And as you talk about those decisions, even at the front line on the manufacturing floor, right? We can execute all the actions on our plan strategy, but someone makes 5 decisions and they've undone the strategy
Right.
without even knowing it.
Right.
Can happen that fast. So you talked earlier about being both process driven and data driven. So as it applies to inputs that inform the strategy, how do you think about getting the right inputs, the right data? How do you structure that to make sure that you're dealing with the knowns and unknowns in a meaningful way?
Well, I'd say one thing is we're really fortunate in private equity, in that when you acquire a company, obviously you do quite a bit of due diligence, and um, we're typically buying smaller companies, so these are 300 people or less. In private equity, that's really kind of a micro company. But we're spending significant dollars during our due diligence before the closing process, on marketing studies, on quality of earnings studies, obviously interviews with the customers, with the leadership team. And so normally what will happen is about 3 to 6 months after we close an acquisition is when we would have our first strategy session. Now we're pretty focused on kind of double checking before we close a deal with the management team on our kind of prime assumptions as far as how we can create value after the close. And the other thing that really benefits us is typically the management team, at least the go forward management team, is buying equity pari passu with us, which means it's the same exact equity. So that's a pretty strong signal that they buy into kind of the analysis we've done. But we bring all of that into the strategy session, and generally it's pretty rich data, and a lot of customer centric data, and numerical, surveys and things like that. So that really helps. And of course, on top of that, we bring in, I would call the standard data that any company should have of, quarterly financials and, all kind of the key metrics, productivity, all the key metrics you would think about are coming in there as well. When we invest, we typically go into an investment planning to make pretty significant investments in capital and in human capital. And so, a lot of times it's kind of validating those kind of decisions before we pull the trigger. And again, that's typically shortly after close.
Yeah. No, that's great. And so capital, of course, is a perhaps a more natural process. But how does, to that point around human capital, how does the strategy affect your decisions around where your gaps are in a portfolio company? Is it the magnitude of performance gap? Is it the amount of shift that the strategy has to take on? How do you assess that need for new human capital to affect the strategy?
We do a pretty significant kind of deep dive on the management team before we close. We're not the type of private equity firm that comes in and like puts our our new leadership team in place or anything like that. I will say in most cases we're either promoting a new person as CEO or bringing in a new CEO because the size companies that we're acquiring, the outgoing CEO is typically the owner, and the motivation for the sale is that they want to retire. So we're not forcing anybody out. Generally, it's more of a nice transition period. But I would say you have to look at your capabilities when you implement a strategy. If you say in a strategy, we need to figure out how to get 30% more productive in manufacturing, and you don't have a solid manufacturing leader and you don't have manufacturing engineering capabilities, it's very unlikely that you're going to achieve that goal. If you say, we're going to vector in this new direction and we're going to go after this new product and we're going to double revenue because we're going to open up a whole new addressable market, but you have no product design team, you're probably not going to be successful. So I think kind of evaluating the team and filling the gaps on the team before you set the strategy is typically how we go about it. So that's why it's 3 to 6 months. Is normally in that first 3 to 6 months is when we're onboarding, new members of the team, like the senior leadership team. And again, from an ownership point of view, what you don't want to do is have a strategy session and then 1 month later you onboard your new COO and they're like, well, I don't buy into this strategy. I wasn't part of putting it together. So, we're generally identifying during due diligence what gaps we think there are in the leadership team, and that is collaborative with the CEO, and then working, with the previous owner and the CEO and whoever else makes sense to put those new people in place. And then once we kind of have the lion's share of that done, we're going to hold the strategy session. I don't think it makes sense to identify a strategy where you really don't have the team to execute on it, and then either not put that team in place, which kind of is setting yourself up for failure, or onboard the team and they don't really buy into that strategy.
Right. Yeah. So then you're really starting to look at making strategic decisions, as a build up to the process, right?
Yeah, for sure. I mean,
each one starts to help shape what you can do once you get in the room.
And we really focus on culture. Obviously, culture and strategy are different, but they're linked.
Right.
And we really invest in trying to improve the culture of companies that we invest in. I try and identify that culture before we make an investment and figure out, how do we kind of, move that culture in the right direction. But I would say, you don't change cultures overnight.
Right.
We're not going to have a culture, fixed, 3 months after we close. But the strategy session ought to be part of kind of that how.
Mm-hmm.
And if we do it the right way, it builds on that culture that we're trying to build.
Yeah. Okay. So you've already talked about the team in this aspect, but how much does the current direction affect what your new direction is? You have customers, you have channels, you have contracts, you have skills, you have assets, you have intellectual property, you have all these things in place taking you in a direction. How much does that direction and all the things that have been invested in it affect your willingness, or how far you're willing to shift to a different direction? So how much are you willing to abandon some of those things to go and take on something completely different?
That's a tough question to answer. I would say you can't ignore where you are. I kind of think about setting a strategy. First of all, I think a strategy is like every 18 months or biannual process. And I think about a strategy and a culture as like kind of jumping from rock to cross a river. You kind of know what's my true north? Where do I want to go? But you can't ignore where you are to figure out how to get where you want to go. And if you try and jump too far in one jump, and maybe you're trying to jump over a rock you could have hit, there's higher likelihood you're going to fall in the water and
Hmm.
set yourself back. So I think it's pretty important to figure out, where are we culturally? Where are we strategically? What's that reasonable kind of rock we could jump to? And you don't want it to be, 6 inches away, because that's not going to stretch the team and it's not going to move you, fast enough in the direction you probably want to move. But most of us can't jump 6 feet either, So if you're looking for that rock that's, 2, 3 feet away, get to that rock, then maybe, you have another strategy session. Okay, what's the next rock that's 2 or 3 feet away? We have the advantage in private equity of having pretty deep pockets. Our fund was $185 million fund, and we're typically investing $10, $15 million in a company. So, if we need to invest another, 5, 7 million in capital, or, whatever, or maybe in the short term, we're giving up on a revenue stream because it's not strategically aligned with where we want to go. We can afford to do that, I would say, much more easily than a company that's owned, by a single shareholder, and, can't put that kind of money into the company.
Right.
But we're also not buying a company and then saying, okay, well, give up all that revenue and let's go in a completely different direction. I mean, that just wouldn't make sense, and it would be really hard to ever achieve the returns that we're looking for if we went that radical.
Yeah. Very interesting. And this might be an unfair, follow-up question to that, but just to maybe help frame it from your investment thesis standpoint, would you rather invest in a company that has a good strategy but just isn't executing on it well, or one that's executing but needs to change its strategy? Roughly speaking, what's more appealing to you as an investor?
Probably a good strategy that's not executing it well. And that's because of the type of private equity firm we are. I would say what differentiates us is kind of the operational skill set that a number of the partners have. I still look in the mirror and see an operator. I'm not a finance guy. And that's really rare to have a managing partner of a private equity firm that's an operating partner versus somebody that kind of came up through investment banking.
Right.
So I think we're more comfortable, if we dig into a company that, hey, they're not really kind of hitting on all cylinders as far as executing, but we really like this industry and we really like kind of the strategic direction that they're going. I wouldn't rule out a situation where they're good executing but going after the wrong strategy. But I would say LFM's comfort level with that is going to be lower, because in general, we assume we're never going to know as much about the industry as the people that already work in that company. And so it would be arrogant, I would say, in my opinion, to do due diligence and just go, oh, these guys have been pursuing the wrong strategy. We think they're a really solid team, but they just don't get it. And we've been studying this industry for 90 days, and we're geniuses and we figured it out. So I think it's more likely that there's something we're missing, and the company's pursuing a logical strategy. And so we're more comfortable if we just see kind of operational holes that we kind of figure, with good blocking and tackling could be fixed.
Yeah. That's great. I appreciate that. And yeah, I think that's it for today.
All righty.
Appreciate you sharing your thoughts and how you guys approach it, and wish you the very best.
Yeah, awesome seeing you, and I appreciate the time.
Thanks.
Thanks.